Tuesday, January 17th, 2023, Maneko 64, home of alternative economics and contrarian views. Just about a month ago, on December 20th, I did a video about whether the BOJ had triggered a global sovereign debt crisis, and we're going to update the situation today. The BOJ is meeting tomorrow at 3 a.m. London time, overnight. They make their decision. It will be, I think, kind of D-Day, not just for the BOJ, but for the whole Western financial system. That's how serious it is. And it's not just me now warning about that. And that's what we're going to look at today. Before I start, though, I'd like to say that I'm going to go over some of the questions you asked from last week at the end of the video after I do the market update. So back to Japan, and I've been warning about Japan and how important the yen is for over 6 years. I mean, if you go on my YouTube channel under content and you search yen, you get about 20 videos. And for example, I've been warning how the yen carry trade is what's kept the dollar relatively strong all these years. And also Abenomics is a big part of the yen carry trade. It kept the yen weak. It kept Japanese rates at negative, the bond yields near zero. Don't forget, until recently, the 10-year JGB yield was kept below 10 basis points, not 25. So the move back in December 2022, on December 20th, to lift that cap from 25 to 50 was very significant, and it was unexpected. And I said at the time, I think they're going to lose the battle because bond yields in Japan should really be more like 1 or 1.25. And this is what people are looking at for tomorrow. But yes, for example, on April 7th, 2016, I made a video and it was entitled Strengthening Yen Pointing to Market Turmoil. Dollar imploding versus yen as Fed credibility evaporates. That was June 2016. Gold spikes to a 5-month high as the dollar breaks, below 110 versus the yen. So we're seeing the same thing with gold now. Gold has caught a very good bid in the last couple of months. And it's mainly because the dollar has topped against the yen, and it looks like it's going to continue. So, back on December 20th, and I'm going to put that video up in the cards and below in the description. That's like my part 1 video of this video. I said at the time it could take weeks, maybe just over a month, for things to get even worse. And lo and behold, there's an article yesterday, for example, in The Telegraph by Ambrose Evans Pritchard, who's their economics market journalist. And he's actually at Davos. And he was listening to the ex-economist or ex-IMF economist. I think his name is, Ken Rogoff. And it says, central banks risk setting off a financial earthquake with constant rate rises, warns ex-IMF economists. I'm going to put a link to this article. You can read the whole thing below in the description under archive.ph. But they go on about Japan. They're talking about how for example, the 10-year yen swap rate is way above the Japanese or the JGB 10-year yield now. So usually it tracked that rate. That means that the BOJ is going to have a very hard time keeping rates at, well, below 0.5% on the 10-year. But the interesting thing they note here is this, and I'm going to read from it. And this is from Ken Rogoff. The Japanese haven't had an interest rate rise in 3 decades, and nobody is positioned for it. Professor Rogoff says the public debt is 260% of GDP, and half of that is overnight debt. And of course, the Bank of Japan and the Japanese pioneered modern day QE. They've been doing QE since 2001, so that's like 22 years. And the article continues, the dam has already begun to break. The Bank of Japan, or BOJ, lifted its long-standing cap on the 10-year bonds from 0.25% to 0.5% last month, seemingly a minor tweak, but in reality a bombshell for international capital flows. The BOJ has had to spend over 100 billion over the last 2 weeks defending the next line against the market onslaught, $100 billion that is. The swaps market is already pricing in another jump. And actually, I think by December 30th, they had spent $128 billion according to the FT article here, as you can see, or 17 trillion yen. And that's a lot of QE there. They don't call it QE, they just say defending the bond market. But let's continue on the article here. And this is the important part that I've been trying to tell people, because the Japanese are, Japan, excuse me, is a huge creditor nation, the biggest creditor nation on the planet. Says a blow up in the Japanese bond market would be a black swan event. And I agree, actually, for once with Ambrose Evans Pritchard. The country is the world's largest creditor with $3.6 trillion of external net assets. It owns 8% of France's public debt. A sudden repatriation of funds would set off contagion through the international system, and by that he means the global sovereign debt market. It would make the European sovereign debt crisis back in 2011, 2012, in my opinion, look like a picnic. So, yes, let's quickly go through what people are expecting tomorrow from the BOJ. And there's an article yesterday from Bloomberg. BOJ meets amid intense speculation over more tweaks. Decision day guide. Most economists expect no change as a base case scenario. Many flag the risk of back-to-back policy shifts this month. Again, I'm going to put this article in the description. You can read the whole thing, but most people, most analysts are concerned that they might tweak that yield curve control target for the 10-year from 50 to 75. But that would really hurt the credibility of the Bank of Japan. So many think that the Bank of Japan needs to focus on yield curve control and that they're going to keep doing QE to keep that rate there. But I think it's a losing battle. And why do I say that? Well, because even though the Bank of Japan owns, I don't know, a huge proportion of the Japanese government bond market, it's probably more than 50%. I'm not sure. But the markets and investors always trump central banks. Central banks are not omnipotent. So if you look at the Japanese yield curve here, this is fresh data. You can see that the 15-year JGB is at 111, the 20-year is at 133, the 30-year at 154. So the 10-year at 0.5 looks a bit silly, doesn't it? I think it should be more like at least 1%, maybe even more. And I expect if they raise this target again, they're going to have to do a lot more QE. This policy of a weak yen and huge QE, zero interest rates, keeping the bond market yields low, has helped keep Western bond markets artificially propped up. And that's been happening, in my opinion, since 2013, when we had the start of Abenomics, which put the policy of QE and the weak yen in steroids. I think that's all reversed now. And we've got the BOJ Governor Kuroda. He's resigning, or he's retiring in April. And I think it's a case of Après moi le déluge. And that's a French term, and I'll go through it. and I think this is what's going to happen. So what does it mean? Is a French expression attributed to King Louis the 15th, or in the form Après nous le déluge, after us the flood, to Madame de Pompadour, his favorite. It is generally regarded as a nihilistic expression of indifference to whatever happens after one is gone, though it may also express a more literal forecasting of ruination. Its meaning is translated by Brewer in the forms, "When I am dead, the deluge may come for aught I care," and ruin, if you like, when we are dead and gone. And it reminds me of the Bank of England former governor, Mark Carney. He retired, guess when? Just before everything kicked off in March 2020. So that was a case of après moi le déluge. There's another case of that when the Labour government lost in 2010. They left, an official at the Treasury left a note to the incoming conservative liberal Democrat coalition government that there's no money left in the Treasury. They left that as a joke, you know, basically you are effed. That was a case of après moi le déluge. So I have a feeling that Kuroda is going to probably get the printing presses going even more quickly. The $150 billion or more that we've seen so far, or almost 20 trillion yen, could look like a small in the next few weeks and months. And I think it could affect the whole government bond market in the world. It could affect treasuries because the Japanese savers, they've been, as you've seen, they own 8% of French government bond. They've been investing in the West because they're getting better returns. But now if the yen is strengthening, that's what you need to understand. If the yen is strengthening so sharply against not just the dollar, but the European currencies, Japanese investors are going to get out of those dollar, euro, pound, or whatever other currency they have debt denominated in, because the yen is strengthening. So I think this is serious, and it's not only me, as you saw, it's even in the mainstream. They're worried about this. So tomorrow will be a big day for the Bank of Japan. They've got their policy meeting. I think Kuroda has his press conference at 3:30 a.m. London time. So that's going to be still today, or the 17th, late New York time. So with that, let's quickly look at where the markets are this morning then. I'm a bit early today. It's 7:40 a.m. London time. So we've got spot gold at 1908. It is down about just under $7. High's been 19, the low 06. Silver is down 22 cents, 24.05. High's been 38, low is 00. Still think it's a great opportunity to get out of this system that could become unhinged. I'm not saying it's going to happen tomorrow with the BOJ, but there's a good possibility, and I've been warning that that was one of the keys for keeping the system afloat, the weak yen, and it looks like that's history now. The yen's gone from, or the dollar's gone from about 150 to 127, 128 in a matter of months, and it could accelerate lower tomorrow. We'll have to see. Quickly to the stock market indices, I won't go through each one of them. They're just down slightly overnight, so not much happening there. Currency markets as well, they're pretty steady, with the exception, let's say, of the dollar. The dollar is a bit stronger versus the yuan. It's up 0.5% at 677. I saw that GDP in China was a lot lower than expected. It came out at, I think, 3% for 2022, and the Chinese government had forecast 5.5%. And the FT is reporting as well that China's population falls, and that's a historic shift. So that's the currencies there. Let's quickly look at the commodities. We've got platinum. Platinum has drifted lower. I still think technically it looks okay. It's at 1,057. It's down about 1% overnight. WTI crude is up a third at 79.40. Brent crude is up a quarter at 84.60. High-grade copper is down almost 0.5% at 4.13, and U.S. nat gas is up 2.5% at 3.53. I've gone over the Japanese bond market. The 10-year yield is trading just around 0.5%. It doesn't look like it spiked today. I think it could do so tomorrow. We'll have to wait and see. Check the U.S. Treasury market here. The 10-year yield is up almost 5 basis points at 3.56. The 2-year is up only 1 at 4.25. So now to last week's questions from the viewers. Let's see, we're gonna go through, let's go through 5 of them today. Question 1 from Jeffrey Morris. Gold in 2023 and beyond. That was the video that I did. He says gold is in an interregnum period. Economic singularity will occur worldwide when the new gold standard system is honored. Could 2023 Q1 and Q2 foreshadow seismicity before gold goes into significant ascendancy as Q3 and Q4 progresses? Definitely, Jeffrey. I think we're seeing that already, the way gold has moved up, and with all the troubles in the global sovereign debt market, that's highly possible. And again, bond markets are very important. They're bigger than equity markets, even though if you go on television, the business news, they only cover stocks. But the bond market is really after gold and silver in the inverted pyramid. It's at the base. It's before equities. It's what really legislates the price of credit and affects all the other markets. So definitely. Question 2 from GrumpStar7, and it's from the same video. How high is the chart projection once the cup and handle is finished? Well, I would say if you look at a cup and handle that we've had since 2011, the low there was 1,045. And I think the top of the cup is around 1,900, right around where we are, or maybe a bit higher. So that's about $1,000. So if you take 1,900 or 2,000 and add 1,000, that's usually the depth of the cup. It could take gold to near 3,000. I'm not saying it's going there, but that's usually how it works. Question 3 here from Dave Bellamy. And this is from the video I did with Clive, interview with Clive Thompson, safeguarding your assets in an age of turbulence. One thing to ask Clive, if there's a CBDC and the currency reset, is there any point in having many CBDCs? Won't it just be a global CBDC currency credit, bringing in global governments and central banking at one time? I think if they are separate, they will get pegged and then become one soon afterwards. So I can't really answer for Clive, but Clive thinks, yeah, a CBDC or a central bank digital currency will just be a new currency that they will replace the dying currencies that we have now. And whether they will be pegged is another question. I don't think they'll peg it to anything real. They're going to try to keep it as a fiat. I don't think it will work. This is from the same interview. Question 4 from Graham S. Why does the price of gold not go up and down in relation to the value of the pound? After all, that's what we paid gold with. Well, it does. If you follow XAUGBP, you can look at what the price of gold in pounds is doing. The reason a lot of people focus on the dollar price is because of the vestige of the Bretton Woods Agreement in 1944. And that set up a gold exchange system where the dollar was pegged to gold. So 1 troy ounce of gold represented 35 fiat dollars or dollars. And foreign governments or treasuries could go to the US Treasury with 35 paper dollars and say, I want my ounce of gold. So since 1944, the focus of the price of gold has been to look at it in dollars, because the dollar has been the major reserve currency, but you can still check the price of gold in pounds. And it moves really the dollars at the common denominator there, of course, as well, because let's say if the pound goes down versus the dollar and the price of gold in dollars doesn't change, then the price of gold in pounds will go up because the pound's going down. Question 5, this is our last question here. Clive never mentioned allocated gold stored in a safe as an option to hold. How safe is allocated gold? Yeah, allocated gold in practice, legally and in theory, should be safe. But of course, there's a counterparty there. And I would favor, though, a counterparty that is not a bank. So that's all I would say about that. Yes. So there you go. If you enjoyed this video, make sure you share it. Make sure you like and subscribe if you haven't subscribed yet. And with that, I wish you all a great day. Take care. Bye.